Welcome back to another episode of YouTube Analysis. It's been a busy week in trading, a lot of crashing companies, a lot of booming companies. To start the new year off with a bang, or a crash in this sense. So what we're going to be talking about as the first company, in particular, in this episode, or the only company in this episode, is going to be Zenith Energy. Zenith Energy was recommended by somebody in the group chat, in particular. And they are an Azerbaijan, Italy, and Argentina operating oil company, oil and exploration. They have a market cap of just below £10 million, and they are quite popular in the community, as you can see with the amount of posts alone today. So let's get back into the facts. This is a company with a market cap of £10 million with a reasonably low market barrels of oil per day operating number. But in particular, they have a potentially large asset in Argentina, which has supposedly multi-million to hundreds of millions net value, but does need a lot of funding in the tens of millions. So this could mean non-dilutive funding, but I don't believe there's any way to get that much money in particular through non-dilutive funding. So there has to be a significant placing or some kind of development on one initial area for less cost, get some revenue, and then reinvest the money in the business. So if I look back to what's happening with their reserves, they have a significant amount of potential revenue. As you can see, 3.2 billion here from the reserves. However, it takes here 626 million in costs. So with the 2 million cash they have now, these are significantly lower and potentially even lower than the market cap now, which overvalues them as of current. But we look at, this is their CEO. He's very confident, as you could tell, but probably it's the CEO to do so anyways. We've got their operations map here in particular, Italy, Azerbaijan, and Argentina. Although the largest one here that looks like is Argentina, but fundamentally speaking, Azerbaijan, the smallest country out of all of them, in particular, has the most value for them in particular as a company. 300 barrels of oil per day is very little in particular, especially for a company of this particular value. However, if you look for a long-term valuation, I'd rather stop for this to drift. If I was personally going to buy this, as to answer the lad who recommended this as question, if I were to buy this, I would probably look for a significant drift down post-funding, because such as Sirius Minerals PLC, you've seen, after their funding, they were probably a quarter of the year peak or half of the year peak, and these guys are currently nearing their year peak, or have already finished that stage of a year peak. Which means with funding as an issue, it's an overwhelming majority feature saying that these guys are not a significant return in buy terms. But if you want to hold it long term, it's merely a gamble, because you know that the fundraising is going to come, but also you know there are some side plays that could potentially create the value. The Argentinians seems to be the cheapest one in particular, or is it the Italian one? I think about approximately these two in particular. They're cheap together, but that Azerbaijani one, that's expensive. How are they going to have that much money? They've probably even sucked up costs in staff payments and what have you. But I don't know. Azerbaijan's a unique one in the market. You don't really see many of these Azerbaijanian plays, especially in the oil industry. Most of them are private companies. These guys in particular, if they could pull it off, it could be something significant. But I'm not buying it until I see some funding or some significant reassurance from the board of directors team to show that this is a long-term hold and they can fund this project without diluting themselves to the ground, such as Excite Energy and many other companies. So to conclude, my personal view on this company is not a long-term buy. No. But it is a conditional change. Say they release a RNS stating that their funding is sorted, non-dilutive funding, something like this, debt on equity. This is good. But when they initially did their placing, they borrowed, or they did the placing to pay off money that they borrowed. It was a debt payment. It was additional funding to pay for debts and some operating costs in 3 projects. But they're not too focused on the other 2 projects, which could prove fatal if this Azerbaijan one doesn't work out. But hey, all it takes is a bit of clarity from the CEO, maybe an interview, or more preferably an RNS statement stating they have sufficient funds to go through this long term, or they could generate revenue in particular before this ordeal begins, and therefore reinvesting in the business, then there's no problem. The share price will soar, potentially 30s, 40s, 50 pence a share. But if they have dilution, you could see this being a tenth of what it is now, but on a much higher value, because dilution. And that's the end of the episode. This is Kia Senseless, aka YouTube Analysis, and I'm out. I hope this clears up any minds.